G'day everyone. Thanks for joining me on this week's Facebook live stream on the Q&A. Thank you. And it's great to see you. We haven't got that many questions today, so everyone's obviously feeling pretty good about things. But that's okay. We'll get through these questions. And remember, this live stream today and my answers will be general advice. May not be appropriate for you, so just please bear that in mind. And if you've got any questions as we're going along, feel free to pop them in. There's plenty of room, and I'll get to them before we finish. So let's get stuck into the questions, shall we? John says, "Hi Alan, do you think Labor's policy to halve the capital gains tax discount will lead to a rush into assets, property shares, for long-term investors? I think SMSFs will be exempt, but I also have some personal investments. So I'm torn between investing now to grandfather in the current CGT rate or holding off due to the loss of franking credit cash refunds, which has stopped me investing locally for some time." Well, John, it is grandfathered. If I could read the actual ALP policy on capital gains tax, it says Labor will halve the capital gains tax discount for all assets purchased after a yet-to-be-determined date after the next election. All investments made before this date will not be affected by the change and will be fully grandfathered. And so, if you're to take this at its word, there'll be a date, the grandfathering date, or the date at which the thing applies will be after the election. It won't be the election date. It'll be sometime afterwards. So it sounds like there'll be time for you to see who wins the election. Obviously, it's most likely to be Labor, but if you wanted to be sure, you could wait until the election. Then you could buy the assets before the yet-to-be-determined date. Otherwise, you could just assume that Labor's going to win and do it now. But look, I do think there'll be a rush to buy assets before the grandfather date, of course. I mean, why not? Why wouldn't you? I mean, if you're thinking of buying anything in the next few years, you better do it before the CGT discount is halved. You might as well, because that's quite, it could end up being quite a lot of money, particularly if you're buying at the bottom of the market. As residential property investments over the next little while are likely to be close to the bottom of the market. 10-year investments at this point are likely to produce decent capital gains. As for franking credit cash refunds, well, look, I'm not quite sure why that stopped you from investing locally. I mean, obviously, I get that you no longer get that benefit of the cash refund, but nor do you get the benefit of any kind of franking credits if you invest offshore. So, really, I don't see the difference, to be honest. And I don't think you should, personally, I don't think anyone should hold off doing anything. I don't think there's any grandfathering involved in the franking credit thing. It's just simply going to be banned. Cash refunds will be banned from when the Labor Party does it. I'll just have a look at their policy on that. But I think, that's really not going to be grandfathered. Obviously, a lot of companies are now starting to try to get in first to distribute the franking credits to people before the election, and I think we're going to see quite a lot of that over the next couple of months before the election. Companies that have got excess franking credits, they're going to try to distribute them to shareholders, as they should. But I don't think you should hold off. I think you should not be torn, John. I think you should, if you're thinking of making any investments in capital gains taxable assets, you should do it before. Either before the election, or if you want to be sure that Labor wins, do it after the election, but before the date that's yet to be determined. Jared says, Sims Metal put out a profit downgrade note the other day and the stock plunged to about $9. In June last year it was nearly 18, so it's halved in that time. And all through this it's had a buyback. It's also had a low of $6 in January 2016, so it seems a very volatile stock. The note cited global trade tensions as the key causes, but I wonder whether that tells the whole story. I would have thought recycling would become more important in the future, but maybe I'm wrong about that, i.e. it is cheaper for BHP and Rio to dig it out of the ground. Could you do a CEO interview to explore these issues so that we can get some insight as to why such volatility and what the future holds for the company? First thing is, Jared, yes, we can do a CEO interview. I'll get them on and we'll talk about that. I think it's a really interesting proposition and interesting business. I don't know much about it, so we'll have to wait until the interview to be definitive. My quick reading of their announcement the other day, their downgrade the other day, suggested that they were talking about competition. So you would have thought that metal recycling would become more important, as you say, Jared, but what's happened, it seems, is that it's become more competitive as well. And so all the margins are being slashed. The prices they're having to pay are rising, and the prices they're getting for the scrap metal is falling. And also, I think you're right about BHP and Rio. I mean, they have made it much cheaper. They've cut their costs enormously, and the prices of those things, those products, iron ore and copper and so on, out of the ground, the prices have gone down. So I think that the cost benefit of scrap has declined versus ore, mined ore. So yeah, it looks like you're right about that, and also the competitive situation with scrap. But yep, we'll get onto it. And to some extent, Robert also says, do you think Sims Metal share price is reflective of the slowdown in the Chinese economy? Probably. I mean, I think it's reflective of the general decline in commodity prices and metal prices that we're seeing, which gets back to what Jared was saying about the, in a sense, the competitive position versus mined ore. Ted says, hi Alan, you interviewed Thomas Baregi or whatever it is, of Credit Corp Group almost 12 months ago. How do you think a business like this may pan out if house prices fall further and let's say Australia were to go into a recession? I assume their book would grow dramatically. I know people need to be able to afford to pay their debt, but I'm thinking a collection business may actually benefit from it most, particularly when the economy starts to turn positive again. Yeah, look, I think you're right. I think that those kind of businesses are good hedges against earnings downturns caused by a recession, for sure. Credit Corp's one of them. Fox Symes is another one. They help people who are in financial trouble. They're not a collection company as such. They kind of provide lending and also services, help people. But also, to some extent, I suppose you'd call them a collection company. And so, yes, I think that is worth looking at for those reasons. Those kind of companies like Credit Corp are worth looking at as hedges in the event of a recession. Anthony says, hi Alan, your thoughts on the profit downgrade by Challenger and the business as a whole? Look, that was the second downgrade by Challenger, and it was obviously done by the new CEO. I think his name's Richard Howes, came in. He just started work this month, and it was an absolute shocker of a downgrade. And so the market is now trying to figure out whether it is just this bloke clearing the decks, or is there something structurally wrong with the business. The thing I think that needs to be understood about Challenger, which I don't think is widely understood by a lot of investors, is that it's as much a funds management business now as it is an annuity business. Now, Challenger's whole DNA, its history, has been in the provision of annuities, and but it's been building up this wealth management business as well, where it's been investing in a whole lot of smaller fund managers. Now, that wealth management business hasn't been going well. It's had a bad time, and I think so. It's been underperforming. It's been losing money, losing funds under management. There's been a big drift of money into ETFs, and so active managers like Challenger have been suffering, particularly also because of the Royal Commission. So that business is in trouble, and the annuities business has not yet had the sort of regulatory support that I think a lot of people were expecting. So the problem with Challenger is a lot of investors were investing in it, pricing it up, and bidding the stock up on the basis, firstly, that it's mainly an annuities business, not a wealth management business. Secondly, there was an expectation that there'd be a government support for annuities. That is to say, there'd be some sort of encouragement for people when they retired to invest their money in an annuity rather than to just take the thing as a lump sum and invest in the market themselves. But that hasn't yet happened. And so what's yet unclear as to, firstly, whether that's going to happen and whether this bloke, Richard Howes, is going to be able to fix the business up. And I think that really it's going to be in the sin bin for a while. I mean, that was a bad downgrade yesterday. That really surprised the market. I don't think the institutions loved that much at all. Analysts didn't like it. And so I think it's going to be off to one side. No one's going to look at it for a while. So I think it's, for at least a few months, even if Richard Howes fixes the place up, it's going to take a while. So, and also, these downgrades, if a company has 2 downgrades, they usually have another third. So, I mean, maybe challenge is different, but I think you could, on past performance of these kind of things, you would expect a 3rd downgrade. So, I think it's a watch and wait situation at this point. But it'll probably have a bit of a bounce in the near term from that big drop yesterday. I think it was 17% yesterday, big fall. So it might bounce from that, but I think it's going to be a rough ride for a little while. And I certainly wouldn't jump into it without waiting to see how it unfolds. That's for sure. James says, "Hi Alan, what do you think of Bennelong's recent performance? I remember this is a fund you recommended, but wondering if this is just symptomatic of the current cycle in the market." Well, James, I don't know about recommending it, but I certainly interviewed the guy who runs the fund, the Bennelong Concentrated Equities Fund, a fellow called Mark East. I interviewed him a year ago because they were the top performing fund according to the Mercer rankings, and most rankings actually, for 2017. So the Bennelong Concentrated Equities Fund produced a return in 2017 of above 30%. So they were the number 1 fund. For that reason, I interviewed Mark East to find out what they were doing, and I made that clear. I said that, this is the top performing fund of 2017. Now, it is actually Mark East and the Bennelong Concentrated Equities Fund are a living example of past performance does not tell you about future performance. There's no guide to future performance, because in 2018, Bennelong's had a shocker. The performance for the year, according to Mercer's ratings for 2018, December 2018, minus 5.4. So number 62 on the list. And the performance for the 3 months to December was minus 13.2, number 90 out of 99. Talk about rooster to feather duster. I tell you what. The performance, I looked on their website, the performance of the Concentrated Equities Fund for the 6 months was minus 18.2, which was an underperformance against its benchmark, which I think is the ASX 200 accumulation fund, of minus 11% underperformance. Goodness me. So, we're putting a call into Mark East to get him back on to talk to him about what the hell went wrong. Because it's all very well to say, the market went down, but gosh, they really underperformed even the market's decline. So that's the thing about, going with stocks, go with fund managers that are, concentrated. And it's in the name, so you know what you're getting. They're not as if they're not true to label. They're calling themselves a concentrated equities fund, and that's what they are. And what that means is they don't own that many stocks. Their core fund, what they call their Bennelong core equities, actually produced a positive performance in 2018 of 2.4% and was 5th on the list. So, that's their kind of, I suppose, not so concentrated fund, and that's done okay. I don't know what their stocks are. I don't know what they bought or they held last year to produce such a shocker, particularly in the second 6 months of minus 18%. they certainly wiped out a bit of their outperformance in 2017, didn't they? So yes, we'll get him on as soon as possible. I'm sure he'll do the interview, and we'll let you know when that's happening. Michael says, assuming investing in a good sound company is a strategy for the long haul, how does an individual investor get access to the fundamentals of a company? Well, I'm glad you asked that, Michael, because the answer is on the InvestSMART website. So you go to the website. You may be a constant investor person at the moment, so your membership has not transitioned across to InvestSMART just yet, but it will do. And InvestSMART has a fantastic database of fundamental information about companies. Phenomenal. It's actually, it's a well-kept secret, if I may say. They don't really make a big deal of it in InvestSMART, but if you go to their website, investsmart.com.au, and you click on, you hover over where it says research and advice, you are taken to a thing called research tools. Click on research tools, and you'll get a database, and there's a whole lot of keyword search fields, sectors, industry groups, market cap, and or you can click on an individual company. So, and they've got full. If you click on a particular company, like I'll click on BHP now, I might put some of this in the overview as to how the resources that are available to you on InvestSMART. It's fantastic. So if you click on BHP, for example, you've got overview, then you've got research, then you've got company financials, which includes everything, company announcements, dividends, change in directors' interests. And not only do you get all of that data for each company, you can then, if you go to the previous field, the one that's got the whole thing, the sort of research tools page, you can search for companies, on particular criteria. So, for example, the top yielding companies, or the top PEs, or the lowest PEs, or and so on. There's a bunch of ways to filter the market to find the stocks that you want, and you can select according to market cap. You can either go for big companies or small companies, medium companies, and so on. So the answer to your question, Michael, is InvestSMART is where you get it. So check it out. Venton says, hi Alan, what do you think of the idea of capping franking credits at a rate, say 70% of current credits, for everyone to make budget savings revenue neutral, with Labor's present approach of picking those who do and those who don't get credits, e.g. pensioners do, industry funds do, self-funded retirees don't? Yeah, look, I agree with you. I think that something like that would be fairer, for sure. At the moment, what they're doing is by just banning cash refunds. That's a very blunt thing, because it assumes that everyone who has a low tax rate or zero tax is actually rich, and has a low tax rate or zero tax rate because they're manipulating it or something. But in fact, most people who have a low tax rate or zero tax have that because they haven't got much money. And so I think it's terrible the way that works. It's too blunt. And we have this argument, so I've been reading tweets by various people, including Peter Martin and who else? Richard Dennis from the Australia Institute, saying that, the people complaining about the Labor policy are all, fat cats, well-heeled people who aren't paying any tax. And therefore, they should be allowed, they're saying that they should be getting a cash refund when they don't pay tax because they're rich. Well, maybe there's some people in that category, but not most of them. And so you end up with this dialogue of the deaf between people who are convinced that it's all about attacking a tax wrought by rich people, and the other people are saying, wait a minute, I'm not rich and I depend on the cash refund, and now I'm not going to get it. So I reckon you're onto something there, Venton. That would actually be a good idea. Don't Duncan says, you mentioned a little while ago it was time to catch up with Jackie at Star Pharma. Yes, it is. They botched up their fast tracking for getting FDA approval for Vivagel. Also at the feisty AGM, Jackie arrogantly told the crowd that she didn't think Star Pharma was a good investment for retail investors because we don't have the necessary patience for biotech companies. Give her a hard time on that. Okay, righto. I will. That's pretty rough things to say. I reckon some of the most... In fact, to suggest that institutional investors are more patient than retail investors is ridiculous. Institutional investors are going from quarter to quarter. That's what they're doing. I mean, they're not patient at all. They just get out. So I don't know what she's talking about. Duncan goes on, shareholders are angry as the company has a bad habit of providing little update to investors while timelines constantly slip, sometimes greater than yearly. Well, that's interesting, Duncan. I did an interview with her a while ago and I thought she was pretty good, but you're telling me that she's arrogant. Okay, we'll get her on and we'll give her a hard time. How's that? Remember the live stream today was, that's it actually, there's no more questions, was general advice, may not be appropriate for you, please bear that in mind. I've got, today we've got the podcast, Talking Finance with Mark Kenny talking about politics, Julia Lee on the markets, Alan Oster on the economy, including this morning's labour market figures, which showed the unemployment rate falling from 5.1 to 5%, and a bloke named Robert Hillard from Deloitte's talking about their survey of C-suite executives. And also it is Warren Zevon's birthday today. Now, he would have turned 72 today, but he died 2003 from mesothelioma. So he was fantastic. Big fan of Warren Zevon. And so in Talking Finance, we've just got a little clip of Lawyers, Guns and Money, which is one of his good songs, but you might know Werewolves of London as well, Excitable Boy, a few other songs like that. So thanks for your company, everyone. Great to see you. Talk to you next week.